We've gotten all these retail earnings, and we should point out it's a mixed bag. Despite the rally we're getting today, you have some stocks doing great. You have other companies like Kohl's doing poorly. Is there a tie that sort of binds all this together?
It's been really difficult to say there is one specific trend around the consumer. I mean, this is the challenge. You get a cross current every day, and then the market trades on that anecdote or that comment from a management team or, same store sales number, and they try and extrapolate it out to the rest of the entire industry. I think it's really hard to tell. We think the consumer is in okay shape. Not exceptional, but okay shape, and that there's a lot of divergence underneath the surface. We know the low-end consumer has been under more stress. We know consumers are worried about the headlines around inflation, even as their own incomes start to grow. But that kind of perception of persistent inflation may lead to a change in behavior in the back half of this year, and that's what we're watching. Short answer, I don't really know. Yeah. It's all over the place.
Well, I mean, I remember, it was a couple of years ago when we were also having these conversations about the health of the consumer, and instead of sort of the consumer dropping off the map, we just tended to see that consumer spending rotate, right?
Yeah.
From goods to services, maybe back to goods and then back to services again. Is it plausible or possible that we just see a rotation in that spending, or is this finally that cliff where consumers just decide, you know what, I've bought enough?
I think there's this big gap between the rhetoric and the action at this point. There's a lot of I feel uncomfortable, and then, perhaps they're going to some stores less than others. But I think the experiential spend is going to be really resilient. And we're going to be watching this throughout the summer as people go to music festivals, as they spend in restaurants, as they travel. Our expectation is, despite the concerns the consumer has and some of the anecdotes coming out of first quarter earnings, the experiential spend is going to look quite good over the next couple months.
So what's positioning like? What do you like? Are you overweight to risk right now? And what does risk mean to Kate?
Yeah, well, Kate likes risk. I think you guys know me well enough to know.
True. You like EM, so I mean, you were an EM person. So
I was an EM person, yeah, and but I love equities still. And I have a friend who sort of dubbed me Miss Bull Market over the last 15 years, but it's not been wrong either. We actually have our overweight equity risk in the portfolio, a tiny bit below where we were in kind of the peak in March, and we see actually a lot of opportunities on these down days. There's some really high quality companies, let's say in the tech space, that are getting a little bit more attractive from a pricing perspective, and that we want to own for a multiple year basis. So we're being opportunistic there. I think we're going to have a good, strong end of this year, even if we have some turbulence over the course of the summer. So for those people who are worried about headlines and worried about the election, I would say don't sit this out. In every presidential election year since 1944, the S&P has ended up at the end of the year. And so look through the turbulence, stay focused on the secular stories, stay focused on technology and growth.
So let's go to technology for a second, because technology is what's getting really hit today, in particular the software stocks like a Salesforce. I know you don't do specific names, but is the idea that, or like broad tech, you want to buy on a dip, or are you being super targeted? Because software will eventually benefit, but basically you're seeing the spend just move from like cloud to AI. It's got to swing back.
Well, I would say even within software, there are a bunch of different verticals that are all getting hit in the same way and doesn't make any sense. Even if companies direct more of their spend towards AI, there are parts of the software space, and I would put kind of cyber and security there, that are going to be Teflon areas of spend. No company can afford to have a data breach. No company can afford to have, any information leak out, especially as they use more cloud-based services and especially as AI becomes a bigger part of their process. So, I mean, those stocks have sold off today as well, and yet I still see very strong fundamentals over the medium term there.
Is that going to be broad-based, though? I mean, everyone's sort of looking for who the winners are. And I mean, up until now, it's been a pretty narrow selection process, right? The NVIDIAs and Microsofts of the world. But everyone is sort of looking for a broadening out of that. Is there, when you look at that main theme here with AI and this sort of new inflection in technology right now, is there hope that this broadens out?
Everyone wants it to broaden out because there's a fear that they've missed it if they haven't been in some specific hardware names over the last year and a half, 2 years. I don't think that's a fear people should have. I think there's a lot more upside. One of the things we talk about on the team is that the total addressable market for AI is so much bigger than anyone even thought 3 months ago, 6 months ago, 12 months ago. We probably don't have a great grasp there. But there are additional opportunities, I think, to invest in the theme. And these are kind of cloud-based services, overall AI infrastructure. And of course, like everyone else, we're doing a lot of work on the data centers and power and the resources required to really power up AI.